I mean, look at the financial crisis. 1.83, 6.26, 6.9, 8.9, 10 point. I mean, are we just immune to recessions here? All right, guys, welcome to this new series. We've been doing this. There are about 20 or 25 stocks that I have chosen for myself. Mo, I don't know if he agrees with these or not, but remember, we're different kind of majority of them. These are stocks I want to own for the long run. But of course, guys, you have to remember, there's stocks I want to own for the long run based on their business model, but there's going to be the right price I need to pay for them. So we're going to do 3 stocks today. Now remember, if you're new to the channel, we're going to do a lot of stuff on our software. We're going to do a lot of stuff here that might seem overwhelming. Just don't worry about it. It's always overwhelming to start. But if it clicks with you, if it makes sense, if the words that we are saying make sense, I encourage you to subscribe and just listen along the way, because when I first became a true investor looking at companies' financials, I was overwhelmed. However, it clicked with me. I said, well, wait a second, this does make sense, because when I buy a stock, I am buying a piece of a business. So, stock number 1, a little company by the name of Microsoft. Have you heard of it?
No.
So let's pull it up in our software and let's talk about, so guys, some of the high level things I like about Microsoft, not financial based. They're in every part of our life. Mm-hmm. In some way, shape, or form. Even if you're a Mac user, you probably use
maybe the email, maybe
Excel, Word. Google Drive is emulating, Teams. And it doesn't even work as well as Microsoft Office and Excel. Are there great things the other uses? Absolutely. But Microsoft is in so many things. You play Xbox, Microsoft. They're trying to buy Activision now. I look at Microsoft as a company that has a lot of immersement in our life and will probably be around for a very, very long time. Now,
especially because of the subscription model.
Yes. So it's a lot of companies, and I will get into that in the third company today. It's one of the big reasons I like the company. But today's company, Microsoft, the subscription model. But look at this, guys. Mo, look at this 5-year return on invested capital.
Yeah, that's insane.
So what this means is this company does a great job of investing the money that's in the business. Through equity holders probably need around 10% return. Debt holders need 6%. So overall, with such a low debt business, look at the market cap versus enterprise value. The difference here is about the debt.
Right.
That means they need to get above a 10% return essentially to create economic value. Guys, the market on average does 10% ROIC. They're at 25.3. Yep. So what does that mean? Well, if they can find better ways to invest their money at rates like this, you should be willing to pay more for the company because they can increase the cash flow and the earnings at a much higher rate than other companies. If they want to increase their revenue or their profit by 20%, if the options are 25% ROIC versus a 15%, you have to invest much less money at 25% to get the same growth that you have to invest if you have found a company with 15%. Yeah. That is the benefit of a high ROIC. What are you smiling about? This is one
of the highest I think I remember.
I mean, yeah, there's some that are in the 30s.
Yeah. But for a big dog, I mean,
yeah, this is incredible.
Company.
Look up Apple. Why don't you look up Apple real quick, Mo, and see what Apple's is? Because I think Apple's is 30%.
Yeah, 30%, 39%.
I was going to say they're high 30s. And it's no coincidence that Warren Buffett loves Apple. Yeah. I'm actually kind of surprised.
Yeah, why doesn't he talk about Microsoft more?
He doesn't. Well, because it's not. We'll see the price here, and I'm quite sure it's not making sense. So the stock currently is at $260. The all-time high was $350 back a little over a year ago. All right, so let's look at the 8 pillars, and look at this, guys. So here's one thing I like: they didn't buy back a ton of shares. That I like, and the reason being is the stock was expensive. Even though we want companies to buy back shares, if they're investing the money by buying back their own expensive shares, they are investing poorly. You don't want that. Now, the great thing about the high ROIC is, as they get to a higher, the less money they have to invest in the business to get high growth, the more money they have in the future to buy back shares. Because this company's not going to grow a ton in the future, right?
No.
It's huge.
It'll be difficult.
It'll be very difficult. But let's see what analysts are expecting, just to see what they're looking at. I mean, look at this, guys. They're expecting to almost double profit, EPS, in the next 5 years. All right, that's pretty solid. That's really good. Probably driven a lot by the high return on invested capital. Okay? And you should pay a premium for high ROIC businesses. But let's look at revenue. This revenue growth is not insane.
No,
it's 50% increase over the next 5 years. Okay, still good. Still good.
It's still really good for a company of this size.
Absolutely. And the world, as it becomes, I mean, look at how much of the world isn't even developed enough to use Microsoft products every single day.
It kind of goes into the same argument with Facebook, WhatsApp, Instagram, Apple products, whatever. The world's not that developed in so many areas.
Correct. And then so when they do develop,
spread their tentacles even there.
Yep, they'll have all these areas to go expand into more revenue streams, especially on a more affordable subscription model.
Yeah.
Right? Instead of paying $350 for a Microsoft Office like you did a few years ago, now you pay $60 every year and you get the whole suite, constant updates, and all online. It's a wonderful, wonderful model. So what are we willing to pay for Microsoft? Now, guys, if you're new, this is our stock analyzer tool. This is the most popular part of our software. The thousands of people who use our software in the community, I always see them sharing their assumptions here in the stock analyzer tool and asking for feedback. Hey, am I too high? Am I too low? What do you think? This is an art. We don't know the future. All we know is that every investment is the present value of all future cash flow. What that means is if I were to give you $1 a year for the rest of your life, how much would you pay me for that today? That's essentially what investing is. But since we don't know the future, we have to make assumptions. My goal is to make more conservative assumptions. That way, when I'm wrong, I'm not too wrong. It's not going to hurt me too bad. I want that margin of safety. So Mo, are you going to do a 20-year analysis?
I think I am.
Okay, I'll do the 10-year, even though I agree with the 20-year analysis, but I'm glad you're doing it.
Okay.
So let's see here.
And remember, if I was doing a 10-year analysis, my assumptions would be higher.
Yes, correct. Because as the company gets larger and larger and larger, it's harder to keep that higher rate of growth going. This is interesting.
Yeah, I don't know if I like my PEs out. I struggle with PEs out 20 years.
Oh, that's the thing, guys. This is the hard part about investing. If we knew the future, you know exactly what to pay for everything at all times.
Right.
You just pick your hurdle rate, which is essentially what rate of return do you need to make. And remember, as I make higher assumptions, I want a larger margin of safety, and I drive that through my desired annual return. And the reason I start at 12% is that's kind of like my minimum, saying, listen, if I can buy an ETF and make 9 or 10%, I need to have a reason to buy an individual stock. So Mo, your assumptions to 20 years.
I did 1, 3, and 5 for revenue.
Jesus Christ.
20 years. So if I was going to do 3, 5, and 7 for 10 years.
So that's what I did 4, 7, 10. Mo,
Yeah.
And by the way, this is part of the conversation I want to have. Mo, I think 1% is obscenely.
I think 1% is very low, but I don't think that. I think the sweet spot here is probably that high side. But if I go 5, 6, 7, or 5, 7, 9, I think it's too high.
Huh. See, I disagree with that.
Over a 20-year period.
And here's why. What's the world GDP growing at? What's the U.S. nominal GDP growing at?
I also am kind of gauging. So let's average this out. What do you think? Analysts are saying over
10% a year for the next 5 years, which is good. But I do think that a company like Microsoft can do 5 to 7% just with natural growth in the U.S. economy and in the world, and adding in all these subscription models that are coming in. I think 1, 3, and I think
3 and 5. I mean, 1 is low. But if I start at 2 or 3,
so I'm not going to ask.
Getting to the high side, this high number would be too high.
If I were doing Mo's on 20 years, 3, 5, 4, 6, 4, 6, 8.
Okay.
Because to me, I can see a world in 20 years of them growing 8% a year for 20 years. That's doubling. That's going to $800 billion in revenue 20 years from now. What they do? I look at that going, okay, the world will be a lot more developed. We're going to have India and China a lot more developed. Yeah, we're probably going to have parts of Africa getting a lot more developed. So I don't think 8% on the high side is an unreasonable estimation for 20 years of revenue, in my opinion, especially with a high return on invested capital.
So let's go. Okay, I'm going to put.
Well, by the way, I don't want you to change
put 5 here, and I want to put 8 here, and then 1. I'll put 3. How about that?
Whatever. Listen, actually, I don't want you to change it.
Let's put 1 there. But I want to change it because I want to put your number in there because I think that 5 is the number. 5 is my number I'm most confident with. So I'll put that one in the middle.
Okay. Sounds good.
Okay.
Profit margin.
28, 30, and 32.
Agreed. Free cash flow margin.
29, 30, 31.
Correct. That's what I did too. However, I would say this, that high return on invested capital, I'm wondering, are we being too conservative at these numbers?
Yeah. Actually,
I don't know.
My profit margin, I increased it while you were talking a little bit.
Oh, did you?
Yeah, because I was thinking about that.
All right, PE.
14, 16, 18.
I don't disagree. I did 15, 16 and a half, and 18.
Okay.
I started to do 14. So I was like, whatever.
Yeah.
And desired annual return.
12, 14, 16.
I agree. All right. My watch list is at 190. That doesn't mean I'm buying it at 190. It just means that notifies me, and I'll probably start selling puts that'll make sense below 190, but at that price. All right, Mo, what do you got?
$14? No, 75 on the
Okay.
low end, 125 on the high end, and I disagree with both, and I actually kind of disagree with yours too. Because
You think it should be higher?
I think it should be higher.
So, by the way,
funny.
Look at this. I'm at 106,
Yeah.
130, and 150 to 160. What do I think I'm really excited about buying Microsoft at? 160 to 180. I just don't know where, but I look at it going, if I can dollar cost average and sell puts at lower prices, get paid along the way, I'm okay with that, I think, with a high return on invested capital.
My watch list is 200.
Oh, great.
I would probably start a position at 175.
So
that's probably where I would begin my position, not go all in at 175, but that's where I would start it.
Remember, guys, you're never going to pick the high. You're never going to pick the low. So with that in mind, it's okay to be patient. That's what we're trying to teach on this channel, the mentality and the emotion of saying, okay, it hit my price. I'm okay if it goes lower. In fact, you'll see Mo and I rooting for lower prices. We're like, hey, I just got Microsoft at 170. I hope it goes to 150. I'll be so excited to buy shares there. That's our plan. Now, it can seem counterintuitive, but again, if you change your framework of thinking. Now, how can these numbers be wrong? Mo, that's a question I'm going to start asking every single video. How can these numbers be wrong? Well, very simply, our inputs.
Yeah, I just changed it. So I just changed my high side. I wanted to see what I would get $175 on the high side, and it was 11% revenue growth over 20 years with the same assumptions and a 16% return.
All right.
That's what would make my 175 number that I just said work for 20 years.
All right. So I personally believe that we're on the right path for Microsoft. I don't think it's worth 260.
No.
I just don't. But then again, look at Apple. I think Warren Buffett values Apple at 140 is my guess. He's fine buying at 140. Mo and I are like 100 or less. You know, we're not as enthusiastic, but we'll see. But how does this not work out? Well, any of these numbers, what if they all of a sudden crush it and their margins skyrocket? Mm-hmm. Let's go to a hypothetical, like you said, Mo. I'll do, let's say for the next 10 years, they do 12%. They increase their margin to 35. And there you go. And I desire return. I want 12% return. All right. Now, all of a sudden, it makes sense.
Now it makes a lot of sense. Now we're buying
I'm buying it today.
I mean, it's worth $300 a share. It's undervalued right now, according to the inputs I just threw in.
So what the whole point here is we are trying to, when I look at these 20, 25 companies that I want to own forever, the key is buying them at a price. I don't think if you told me I have to rely on this to make my number one investing decision, I'm not doing that.
See, that's a good point of what you just said. You have to rely on that number. You have to rely on that to pay $300 a share today to be worth it. And that's hard to do.
That's hard to do, but that is the big key to investing. Now, as I made my returns, my assumptions higher, I put a higher return in. But hey, I look at this going, damn, I could buy this thing at 157 and they crush it. I would crush it. Remember, you have to be patient in investing. That's why puts are so popular with us. That's why day trading and long-term trading is popular. It keeps you active to avoid you from making mistakes because you have FOMO. Just be patient. Mm-hmm. All right. Stock number 2, Visa. Now we're going to go into this company a little bit faster because we already did the thorough Microsoft analysis. But look at Visa going, boy, guys, Visa's everywhere. Visa is the company. It's at $215. I mean, if you don't have a Visa, what hole are you? You're Ted Kaczynski. You know what I mean?
I have 3 in my wallet right now.
Do you?
Yeah.
I have 2. 5 years, it's up 90%. 10 years, it's up 486%.
Wow.
But I don't think it's been around for that long. Yeah, it went public in 08 or 07 or something.
Good ROIC, 24.1%, and the 5 year is 19%.
Yeah, so there's a lot of big benefits here.
Look at that gross margin.
That's the thing. Look at the gross margin, 80.4, and look at the bottom line margin.
51%.
This is after tax.
Yeah.
So the difference between this and this is overhead and taxes. They pay 30% in overhead and taxes.
Yeah, that's wild.
I look at this going, wow, okay. Very high ROIC business.
Yeah, pay a little dividend.
A little bit of a dividend. It's adorable, 0.7%. Let's go to the 8 pillars. And look, another one that's like Microsoft.
Exactly.
You've got, what we have here is we have a company that has a check mark and everything. They're buying back some shares.
Yeah.
Okay.
Yeah.
But a higher higher PE and higher price of free cash flow the last 5 years. Okay, remember, these are the things that can fall the fastest. You know why? Because over time, if prices go down, which we believe we're in a bear market that's going to be longer lasting than a lot of people believe, but as Visa's fundamentals get better and the price comes down, this is going to fall much faster, getting to our sweet spot.
So this is another one of those companies, every single year over the last decade, they've just been buying back shares instead of buying them back at better prices, good prices. I mean, I don't like saying.
See, to me, that's where you look at.
I'm noticing a lot of these companies are doing that, the big daddies.
See, that's where I get concerned about long term. How do the executive team look at our money? Because that's our money we're talking about. If you own a share of Visa, they are in charge of allocating your capital because you have a stake in that capital in the business. So how do they sit there and allocate it? If they're buying back shares, I go, oh, poop.
And they just do it no matter what.
So one of the things I want to look at is let's go see if they have the financials. I mean, look at the financial crisis.
I'm sure they went up.
1.83, 6.26, 6.9, 8.9, 10 point. I mean, are we just immune to recessions here? Again, and as the world gets better and better economically, Visa's going to be there getting more people in China, India, and Africa. I mean, guys, how many people live in China, India, and Africa all combined? 4.5 billion? China's 1.6, India's 1.6, it's 3.2. How many are in Africa? 1.2. So yeah, we're at 4.5 billion people that I don't know what the penetration rate for Visa is in those areas. There's a lot of growth potential.
It's rather large.
it's rather large.
Yes.
All right, so let's look at analysts. What are analysts saying? Profit pretty much gonna double in the next 5 years. Revenue is gonna go up 50%, 45% in the next 5 years. Okay. All right. And look, this is the whole high ROIC. They can really jump up their EPS because of the higher ROIC. Okay, stock analyzer tool. Mo, do you want to handle the 20-year again?
Sure.
Okay. Let's see here. So I find myself doing a lot higher PEs and price of free cash flows lately when I started to understand return on invested capital more. As I was reassessing my process for doing investments, I was like, what am I missing that Warren Buffett and Charlie Munger see so much more value in businesses than I do? And I started doing more and more research, and ROIC was it. All right. Analyze button. Stock is currently at 215. It's on my watch list at 150. My prices are a low of 90 to 100, a high of 145 to 160, a middle price of 115 to 125. And Mo's doing a 20-year analysis versus 10-year. What do you got?
So I have 86 to 92. 103 to 113, middle ground. I would call it $100.
Okay. So I have my watch list at 150. High ROIC business. It's hard to, I mean, Visa is the name. I would feel very comfortable, good balance sheet. I'd feel very comfortable starting to sell put, even though my high price is 150. I look at that high ROIC going, okay.
I could do that. I could start a position there.
Yeah. And I'm going to look at that and maybe actually should change my, I'm going to change my watch list to 165 so I can start selling puts at 165 instead of.
I actually did 175.
Oh, wow. Did you really?
Yeah. Because, I mean, if you go, let's call it 8 weeks to 10 weeks out, you might be able to get some pretty good options on it.
Might be right.
You know, who knows?
So my watch list is currently at 107. But the point is, I have it on my watch list. This is why we do the videos. It allows me to alter these numbers as time goes on. That's the benefit of the software. By the way, if you like the software, everythingmoney.com, check it out. We have a risk-free guarantee going now. If you sign up within 30 days, if you're not satisfied for some reason, if you don't like the thousands of people in here that have great conversations about investing, email us. We'll give you your money back, no questions asked. Final company. This is the other one that's converting to a lot more subscription. Adobe. Adobe is the leader. All-time high, a little bit over a year ago at 700. It's currently at 344. That's a drop of over 50%. And for a company like Adobe, guys, you'd be hard-pressed to find people who really believe that was going to happen. But it's down in half, and we're going to see what it's worth to us. No dividend right now. High return on invested capital over 5 years at 18.4%. High return on assets. Best part is, look at this market cap versus enterprise value. Basically, the difference is the debt level. I mean, the calculation is, I took it from somebody just to how they calculate it. There's multiple ways of looking at enterprise value, but basically very low debt, good balance sheet. All right, so just like Microsoft, just like Visa, we've got all checks except for these two. Now, here's one thing I like. Higher free cash flow, than PE. Now you might look at that and go, Paul, this number is lower. Yes, but this is the ratio of price to free cash flow. So a lower ratio means we have a higher free cash flow than earnings. So I'd rather have that than the other way around.
Right.
Man, look at these margins too, Mo.
I know.
88% gross margin. Bottom line, 30%. I think that's more in line with Microsoft, what they were doing.
Yeah.
Microsoft had a lower gross profit margin, though.
Right.
Wow,
almost 90% gross profit margin.
Yeah. Do you like that, Mo?
I do.
What are our good friends, the analysts, saying?
Let's see.
A lot of analysts following.
Yeah, I was going to say there are probably a lot of them.
Okay, low double-digit EPS growth. Not as much revenue growth. It makes sense. I mean, they're a very unique product. They're very specific to designers. But one thing I want everybody to remember is you go to websites like Upwork and freelance.com and fiverr.com. You can hire. It's funny. My fiance, when we go on trips, she loves taking pictures of us. But invariably, every time we take a picture, what's in the background?
People.
And she's like, Paul, can you please get these edited out? Sure, no problem. I find somebody on Upwork. I already have the people. Hey, edit these people out. And literally it comes out like there's nobody ever there. Yeah. And I'm blown away by it. Literally, it looks like there's nobody there. We had a beautiful picture in Zermatt. And there was like 18 people in the background. Not 18, maybe, I don't know what the number was, but one lady's like looking at us like this. And Lisa's like, that lady's got to go.
I like the one with the bag.
The bag.
You were shopping and they just edited out the shopping bag.
Well, not only that, you didn't also know that there were people. There was like 40 people in that picture. People. That original picture had 40 people. And then it had my bag. And I felt like just a pretentious prick that I probably am, holding this nice bag.
You were holding a Walmart bag?
Yeah, it was a Walmart bag. So, all right. So Mo's going to do 20 and I'm going to do 10-year growth. So guys, and the other thing, I want to reiterate this stuff in the PE and price of free cash flow. It all depends on the situation. If I'm finding a much smaller company with a lot more unknowns and things like that, I'm doing a much lower PE. But these companies are big brands, high return on invested capital. It's going to be great. I hate to use the term moats, but it's going to be hard for them to go away. So I'm willing to do a much higher PE. Just like US government. I'm going to get a much lower rate, which is a higher PE for a government bill treasury than I would for a corporate bond, right? Because a corporation can go bankrupt a lot more likely than the government. Well, let's not get into that conversation, but the bottom line is, it is a lot more backstop there. So the stock's currently 344. I hit the analyze button. My current watch list price is 200. You don't have it on your watch list.
I don't have it on my watch list.
So my prices, a low price of 120 to 160, high price of 185 to 250, middle price of 200 to 150. So this one's actually a lot closer than in terms of like, okay, what was yours?
100 to 142, 165 to 225, and a middle ground, probably in the middle there, probably 140.
So what is my determination going to be on these companies? You saw these videos, guys. Subscribe if this made sense. We look at every stock as buying a piece of a business. I'm looking at the cash flow, but this is the art of investing. Where do I enter? 200 sounds about right for me to start selling puts on it, but it's got a ways to go. It's just math. I appreciate your time. Don't forget to subscribe. Take care. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?